The topic is titled as Securitization. Now, in many textbooks, you will find title of this topic even as Debt Securitization. So, whether it is Debt Securitization or simply Securitization, it means one and the same. So, if I have to define this securitization term in just one line, I would say securitization is a process of converting homogeneous illiquid assets into marketable securities. Now, reading this one line definition, no one can typically understand what kind of process we are actually talking about. This summary of one line can be actually understood only when you have understood the whole process. Now, basically, if you look into the details of that definition, it is a process of converting homogeneous illiquid assets. That means, first of all, you should have illiquid assets in your hand, which should be homogeneous, same type of illiquid assets, and then you are attempting to convert these illiquid assets into liquid, marketable securities. That means something which is not a security, not a marketable security right now, it is an illiquid asset, you are attempting to convert that into a security. That is why the process is called securitization. So, it is a process of converting an illiquid asset into a marketable security. Now, let us go little deeper into the meaning of this concept, securitization. So, friends, we would say, just imagine there is a finance company which is into lending. So, imagine a finance company has gathered a capital base of rupees 400 crores. Now, it started lending money. You know, companies, individuals, they are applying for loans, and this company, this finance company is typically giving only secured loans, loan against property only. You mortgage your property and take the loan. Now, what will happen? Entities will approach, individuals will approach, different parties would approach, and they would demand loan sanctioning from this finance company. Looking into the credit rating, looking into the risk aspect of that, the finance company will start granting loans one by one. Now, what happens? As and when this finance company is granting loans, it will develop a long-term receivable, because it will have an outflow of cash on immediate basis, and then it will create for itself a long-term receivable. So, assume that each party is approaching for a loan of around rupees 4 crores. 100 parties have approached. This finance company has distributed loans to 100 parties of rupees 4 crores each. Now, 400 crores of fund available with the finance company has been vanished. All has been converted into long-term receivable. So, the present value of that long-term receivable will be 400 crores. So, if you look into the balance sheet of that finance company, it still has an asset of 400 crores, but not in liquid form. This will take 10 years of time to recover, correct? Definitely the amount of recovery will be big amount. Now, to each customer who has borrowed money from this finance company, each customer will be specified a particular amount of EMI, correct? On EMI basis, or maybe on quarterly basis, or in some cases half yearly or annual basis, the payment structure will be defined. But these all recoveries along with interest will be made in future. So, what is the problem? The problem is, this finance company has just emptied its entire fund. Now, it does not have any more funds to grant loan to somebody else, but borrowers might keep approaching. So, if a borrower comes, this finance company could simply say, boss, now we are done. We have just given up. We have distributed all the loans to customers who have come earlier. Now you do one thing, you wait until we get back some money, we will then give you loans, because currently even we don't have availability of funds. Now what will the customer or the borrower do? Will the borrower wait for this finance company? Obviously not. This borrower is having his own property to mortgage and borrow money. This borrower may simply now move to other bank or other finance company. Why would the borrower wait? Because borrower is in need of money. Borrower will not even wait for a single day. Forget about waiting for years of time for you to gather money and give loan to this borrower. That means this finance company will lose its business if it is letting go this particular borrower. In this highly competitive market, banks and finance companies, they have big targets to grant loans, correct? On the other side, if you don't have funds in hands, how will you manage your operational business? How will you manage to give loans to the new coming borrower? Now this is a problem. So basically, in company's balance sheet, I told you there is a big receivable, that too secured receivable, because all these loans have been given against property. The title deeds of properties are lying with the company, but now the company is not having liquid funds to grant more loans. That is the problem. So here there will be a process required of converting these assets, which are illiquid assets, that is the loan receivables, into marketable securities, and these marketable securities can be issued to investors. Investors will give money to buy these securities, and with that money, finally rooted in the hands of the finance company, it will be again having liquidity in hands to grant loans to more and more borrowers. So friends, now I will be explaining you this process in much more details, and before I explain that, I would want you to write down the definition and meaning of the word securitization, and that will be followed by the process of securitization. So friends, I would just ask you to keep lot of patience, because if you are learning this concept for the first time, you will need a lot of clear understanding for this whole process to function. This is a big process. What I have just conveyed to you is the summary of that process. So let us do one thing. Let us first focus on the screen to note down the definition and meaning of securitization. So the term securitization, it refers to pooling and repackaging of homogeneous illiquid financial assets into marketable securities. That means liquid marketable securities. Something important that you should understand over here, that this is pooling and repackaging. Now pooling and repackaging of what? Homogeneous. Homogeneous means the assets have to be of similar type. They are necessarily illiquid assets, but on the other side they are financial assets. As I have mentioned earlier, financial assets indicating the long-term receivable, and because they are long-term receivable, currently they are having this feature that they are illiquid, and we are attempting to convert these into liquid marketable securities. So the definition goes this way: securitization is the process of pooling and repackaging of homogeneous illiquid financial assets into liquid marketable securities that can be sold to investors. Alright friends, after writing this definition, let us try to understand in detail the process of securitization. So securitization process, as I have explained, it begins with a borrower approaching a finance company or a bank for borrowing money, of course. So this borrower has a property, so this property is going to be mortgaged with this bank for the purpose of availing a loan facility. That means this loan which the borrower is seeking is the loan against this property. So the property is mortgaged with the bank, and bank sanctions the loan to the borrower. So what do you think this property has undergone? This property, the possession of this property is still with the borrower, right? The property doesn't move to the bank. what moves to the bank is not the property but the title deed of that property. It is the title deed of that property that is given to the bank as mortgage. And what bank does? Bank keeps this title deed in its safe locker. Now, the point is, if you have understood the process by far, the borrower has approached the bank for a loan, borrower has mortgaged his or her property, bank has given loan against property, and the title deeds of this property have been given by borrower to the bank, and those title deeds are now lying in the custody of the bank. Now, in the same way, when more borrowers approach, they would also have their own properties, because the bank or finance company we are talking about, it is very clear, it will provide loan only and only against properties. Only secured loans, no unsecured loans shall be given. Now, what will happen? All these borrowers have these properties. The title deeds of these properties are again submitted to the bank, and with this mortgage, the bank is able to provide loans to these borrowers. So, if you could now see, with the multiple loans given by far, the bank has created a mortgage pool. It is a pool of these mortgaged assets, correct? And observe the nature of this mortgage pool. This is completely illiquid, because this represents the properties, right? And it also is a collateral to the loan receivables, but these loan receivables will not be received now. These will be received at later stages, and therefore right now the liquidity in the hands of the bank has not been there, because all its liquid funds have been utilized for giving loans to all these borrowers. So by far everything is fine, but what happens when more borrowers approach? Now more borrowers have been lined up, and now the problem is that the bank is not having any funds to offer. This is the problem. So right now, can you see the problem area? The bank is not having liquidity for granting more loans. However, there are more borrowers who have lined up to borrow money from the bank. So the question that now arises is, how would this bank or finance company manage with this situation of lack of funds? So it does not have funds in hand, more borrowers have been lined up, you can see, and this bank is completely out of funds. It is having assets in its balance sheet, but what we can see, these are a pool of mortgages. These are indicating long-term receivables. So friends, understand the point very well. In the balance sheet of the bank, what is there as its asset is long-term receivable, which we are identifying as illiquid assets. However, these are secured assets because they are backed with a collateral. They are backed with mortgages. So we will call these as a pool of mortgages, which bank is having in its hand as an asset, but it is illiquid. Now what does bank do at this point? Bank appoints an agency. Okay, bank appoints a separate entity to work as its agent. This separate entity is called special purpose entity or special purpose vehicle, SPV. This SPV is going to issue securities. That means this is a separate entity which will issue securities on the backing of this mortgage pool. So what would bank do? Bank would first pass on this mortgage pool to the special purpose entity. The moment special purpose entity is getting this mortgage pool, it will make a complete analysis of by when how much money is receivable from all these long-term receivables. It will make a complete chart of date-wise receivables recovery and accordingly start planning the issue of securities, and this mortgage pool will be considered as a backing which can give an assurance of recovery. In other words, this SPV or SPE, special purpose entity, will issue securities at the backing of this mortgage pool, and therefore these securities are known as mortgage backed securities, MBS, mortgage backed securities. However, there is one more aspect in this process involved. Before issuing these securities, this special purpose entity will appoint a credit rating agency to have a credit rating of this entire mortgage pool. The credit rating agency, its task is to take fees and provide the service of credit rating. So credit rating agency will actually provide the rating of these mortgage pool, and accordingly the rating of the securities which will be issued by SPE. That means the SPE now will have all its securities which is to be issued rated by this credit rating agency, and therefore investors have trust on this credit rating agency. Based on the rating of that, the investors are now finding this security clearly worth investing, and so the investors will then put their money, which will eventually be utilized for providing liquidity to the bank or finance company which was the originator in this entire arrangement. So this bank or finance company which is having problem of shortage of funds is called the originator in this entire arrangement. So friends, do one thing, whatever I have discussed, I am showing the same thing on the screen. Please keep paying attention and have a lot of patience in order to understand the whole process properly. Alright, so let us continue with the process of securitization. At this junction, we have discussed that this bank is going to appoint an agency known as SPV, special purpose vehicle, or it could be called a special purpose entity. And this mortgage pool that the bank has created, it will be passed on to this SPV. That means this SPV will now have the backing of this mortgage pool. The mortgage pool got transferred to the SPV. Now SPV itself will appoint a credit rating agency, and this credit rating agency will evaluate this entire mortgage pool, which basically represents receivables on a long-term basis. And based on the credit rating provided by the CRA, that is credit rating agency, this SPV will issue securities, and that process is mainly known as securitization. So it will be issuing certain kind of securities or bonds, and these bonds will be categorized or classified by CRA, that is by the credit rating agency, into different categories or tranches, and the rating of these bonds could be AAA, AA or single A. AAA rated bond are most secured bonds, AA rated bonds little lesser secured, A rated bonds still little lesser secured. However, based on the rating of the bonds, the interest rate would also vary, because these are almost kind of risk-free investments. These will have very low rate of interest, moderate rate of interest, and little higher rate of interest with A rated bonds. Definitely the objective is B and C rated bonds will not be brought into picture, because they will have poor credit rating and therefore could be considered as risky investment itself. Now, based on the rating of these securities made by CRA, that is credit rating agencies, the investors have built up a trust on the rating of this agency, and finally they are willing to invest into these securities depending upon what kind of risk they would want to take, or what could be the period of investment they are looking for. And finally they would give their monies for purchase of these bonds to the SPV. That means the cash flow moves from the investors to the special purpose entity, and special purpose entity will now in turn issue bonds to them. Finally, when SPV has obtained this cash flow will be passed on to the originator over here, and finally the problem of shortage of funds no longer exists, and this bank or finance company or the originator got that liquidity which it was requiring. Alright friends, so what we have just seen over here is the complete process of securitization. Now, there will be some questions in your mind, as in, what is the benefit of this special purpose entity in this whole scenario? What is the benefit of the credit rating agency? Let me explain you. Each party involved over here as an intermediary will be benefited. Now see what happens. Think from the viewpoint of the investors. When investors are investing their money, they are investing their money in almost risk-free kind of securities which are high rated bonds by credit rating agency. So the rate of interest will be fairly low. That means SPV or special purpose vehicle or special purpose entity is able to get the subscription of these securities at a very low rate of interest. Assume that such low rate of interest is just 6% per annum. On the other side, SPV will get this money from the investors at 6% per annum. Now this money will be passed on to the bank at a little higher rate, maybe say 9% per annum. So the differential between 6% and 9%, that interest rate differential will be the gross earnings for this SPV, and SPV itself will pay a lump sum fee to the credit rating agency for their services. So credit rating agency got its fee for its own services rendered. SPV gets that marginal difference of the interest rate on a long-term basis as its own earnings. And secondly, the bank got this new money, new funds at 9% rate from SPV. It will eventually offer loans to its own customers who are the borrowers. These loans will be offered to them at still higher rate, maybe 12%. So bank is also generating some margin on these funds. So friends, this was the whole process of securitization. There is one more thing I would like to speak about. When the mortgage pool was analyzed by the special purpose entity, it would have made a list of when and how much money will be recovered, and based on that it will make categories of different type of securities to be issued. Now these categories are not about risk involved, because that categorization, those tranches were planned by the credit rating agency. That rating was done by the CRA. What is the role of SPE over here? Special purpose entity will now issue securities which will become due in as short as 6 months or 12 months or 18 months or 2 years, 3 years, 4 years, 5 years, based on the pattern of recovery, how much money they are going to recover from the mortgage pool. They will issue securities of that long duration. The highest period would be 10-year period. In that case, the securities will also include long-term securities which will mature after 10 years. So the securities will be classified in terms of their maturity or their life, and they will also be classified in accordance with the risk involved in those securities, which will be done by credit rating agency. And friends, therefore you can see one thing through this whole process of securitization. Investors are people from general public. Borrowers also represent general public. So money of general public has been picked from them and passed on to the general public again. But there were 3 intermediaries involved: the originator, the bank itself; secondly, the SPE; and thirdly, it was the credit rating agency. And each of these intermediaries are taking their own charges, fees, commission, differential interest as their own income for their own benefits. So friends, I believe you have clearly understood this whole process of securitization. The detailed theory part has been given in your textbooks. So just prepare this very well and watch this video at least 2-3 times before examination to get this clarity about how the securitization process works. So let us declare this as end of this session. Thank you so much for attending this class.